Hello everyone, welcome back to our channel where we explore the world of finance and investing. Today, we're diving into the classic book, A Random Walk Down Wall Street, including a life cycle guide to personal investing by Burton G. Malkiel. But before we jump into the key points, let's learn a little about the author. Burton Malkiel is an American economist and author. He has a long and impressive academic career with a Ph.D. from Princeton University, where he also serves as a professor. Malkiel is a strong advocate of the efficient market hypothesis and has written extensively about investing, personal finance, and the stock market. Now, let's jump right into the 10 key points from A Random Walk Down Wall Street and explore the insights that have made it a must-read for investors worldwide. 1. The efficient market hypothesis. The core idea behind the book is the efficient market hypothesis, which posits that stock prices reflect all available information, making it virtually impossible to consistently outperform the market through stock picking or market timing. Malkiel argues that the market is so efficient that any new information is immediately incorporated into stock prices, leaving little room for investors to profit from this knowledge. This concept is crucial for investors to understand because it challenges the traditional idea that one can beat the market through skillful stock selection. Instead, Malkiel suggests that investors should focus on low-cost index funds, which provide broad exposure to the market without incurring excessive fees. 2. The random walk theory. The random walk theory, which is central to the book, suggests that stock prices follow a random, unpredictable path. This means that it is impossible to consistently predict the direction of stock prices or identify undervalued stocks based on historical data or market analysis. Malkiel supports this theory with extensive research and historical evidence, debunking many commonly held beliefs about investing. As a result, he encourages investors to adopt a passive, long-term investment strategy that doesn't rely on market timing or stock picking. 3. The importance of diversification. Malkiel stresses the importance of diversification in investment portfolios. By spreading investments across different asset classes, geographic regions, and industries, investors can reduce the overall risk associated with their portfolios without sacrificing potential returns. Diversification is crucial because it helps protect investors from the unpredictable nature of individual stocks and market segments. By holding a diversified portfolio, investors can minimize the impact of poor-performing investments while still benefiting from the long-term growth of the market. 4. Long-term investing. In A Random Walk Down Wall Street, Malkiel advocates for a long-term investment approach. He argues that investors should focus on building a well-diversified portfolio and avoid short-term trading or market timing strategies, which often lead to higher costs and lower returns. The benefits of long-term investing include lower transaction costs, fewer taxes, and the ability to take advantage of the power of compounding returns. This approach also helps investors avoid the emotional pitfalls of trying to time the market or react to short-term market fluctuations. 5. Dollar cost averaging. Dollar cost averaging is a strategy that Malkiel recommends for investors who want to minimize the impact of market fluctuations on their investments. This involves regularly investing a fixed amount of money, regardless of market conditions, over a long period. By consistently investing a set amount, investors can take advantage of market dips by purchasing more shares when prices are low and fewer shares when prices are high. This disciplined approach helps to average out the cost of investments over time and reduces the impact of market volatility on an investor's portfolio. 6. Rebalancing. Malkiel emphasizes the importance of regularly rebalancing your investment portfolio. Rebalancing involves adjusting the allocation of assets within your portfolio to maintain a desired level of risk and return. This typically requires selling assets that have performed well and buying underperforming assets to maintain the original target allocation. Regular rebalancing helps to maintain a consistent risk profile and ensures that an investor's portfolio remains aligned with their long-term financial goals. It also helps to lock in gains from well-performing assets and take advantage of potential opportunities in underperforming assets. 7. Low-cost index funds. One of the most significant takeaways from A Random Walk Down Wall Street is Malkiel's recommendation to invest in low-cost index funds. These funds track the performance of a broad market index, such as the S&P 500, and provide investors with diversified exposure to the market at a low cost. By investing in low-cost index funds, investors can gain exposure to the market's overall performance without attempting to pick individual stocks or time the market. This approach aligns with the efficient market hypothesis and the random walk theory, as it allows investors to achieve market returns while minimizing fees and expenses. 8. The role of bonds. Bonds play an essential role in a diversified investment portfolio, according to Malkiel. While they may offer lower returns than stocks over the long term, bonds provide stability and help to reduce overall portfolio risk. The allocation of bonds in an investor's portfolio should be based on their risk tolerance, investment horizon, and financial goals. As investors approach retirement or other financial milestones, they may choose to increase their bond allocation to protect their assets and reduce the impact of market volatility. 9. Tax-efficient investing. Malkiel highlights the importance of tax-efficient investing for maximizing long-term returns. By considering the tax implications of investment decisions, investors can minimize the amount of taxes they owe and increase their overall returns. Strategies for tax-efficient investing include using tax-advantaged accounts, such as IRA or 401(k)s, choosing tax-efficient investment vehicles, and being mindful of the tax consequences of selling investments. By focusing on tax efficiency, investors can keep more of their hard-earned gains. 10. Behavioral finance. In A Random Walk Down Wall Street, Malkiel explores the field of behavioral finance, which examines the psychological factors that influence investment decisions. He highlights common cognitive biases and emotional pitfalls that can lead investors to make poor decisions. By understanding these biases and adopting a disciplined, long-term investment strategy, investors can avoid many of the common mistakes that result from emotional or irrational decision-making. This approach helps to ensure that investors remain focused on their long-term financial goals, rather than getting caught up in short-term market fluctuations. In conclusion, A Random Walk Down Wall Street by Burton G. Malkiel is a must-read for anyone looking to build a solid foundation in personal investing. By understanding the key principles of the efficient market hypothesis, the random walk theory, and the importance of diversification, long-term investing, and behavioral finance, investors can make informed decisions and build a successful investment strategy. That's it for today's video. We hope you enjoyed this deep dive into A Random Walk Down Wall Street and found the insights valuable for your own investing journey. If you did, please give this video a thumbs up and don't forget to subscribe to our channel for more financial wisdom. See you in the next video.